Hi, this is Mitch Kramer and Trey Talley. Welcome to the May 2024 webinar Fluent Financial is putting on. We're going to be talking about what's been going on in the markets, the economy, and you're going to hear kind of a similar theme that you've heard all this year. Unfortunately, the data continues to deteriorate, and we are creeping closer to a recession, contrary to what the media and you may be reading about. So we'll go ahead and get started. First slide is the compliance page, and all the information that we talk about is Fluent Financial's opinion, not private client services. So this first chart, I'll let Trey get into this, but we've done a couple of things at the recommendations of people who attend these webinars, and we love your feedback. You're going to see some charts in this month's webinar that are much more colorful, much more easier to read. I know a lot of you may be trying to look at this on a cell phone or tablet, where a computer screen would be the ideal environment, but we're trying to make this as user-friendly as possible. So with that, I'll go ahead and turn this over to Trey.
Hello, everyone. Thanks, Mitch. So what we're looking at here is just a chart of some of the major indices from the beginning of 2022. And the Russell is still struggling to get out of that trench there. It's down about 3.8% over that time. Some of the more higher beta indices like the NASDAQ and the S&P 500, they have recovered that high watermark there, as you can see that in the chart. So this webinar this month, we're going to talk about rate cuts that are coming down the pipeline. Kind of looks like September is when the first rate cut will kick off, maybe another in December. So we'll talk about some of that reprieve in the back half of this year. We'll talk about the ongoing economic softness. Inflation is still with us. It's still persisting above the Fed's target, which means they can't get out of the way. And until they do, it's just really not prudent to take on risk. But we'll talk about inflation, kind of what's driving it, and talk about some of those dynamics.
Okay. All right. Now, and speaking of the new chart format, Trey, I was really impressed with what you did with this Bloomberg chart. And Bloomberg likes everything in black and orange, but I like the colors, and this little mountain chart's a new addition. So why don't you kind of tell people what they're looking at?
Right. So this is the leading economic index here from the Conference Board. We plot it as a year-over-year measure to try and assess the rate of change. So as you see on the right-hand side of the chart, we're at negative 5.5, so negative 5.5% year-over-year change in that index. And that generally has gave way to a recession over the next 12 months there. This year-over-year figure started to curl up there at about October of last year. Those are generally really good signals to go on and take risk in the markets. What's different about this cycle is the index itself actually continues to move lower, albeit at a slower pace. So that's that small embedded chart there in the middle is just the actual index there. So we can see that the leading economic data continues to slide down. And so we want to just characterize where we are in that environment. Perhaps some of the worst is behind us in terms of the deceleration, but we would generally like to see the index starting to move up. That's again giving us confidence. Things are improving in the economy, which means things will improve in the stock market, and you can take risk and get paid for it. So that's kind of where we are from a very high level at the economic view. The next slide here, we kind of look at some of the performance of some of the bigger indices. And so major benchmarks on the left, we're on the right there. And so some of the really rate sensitive sectors of the economy continue to be weaken here. And we see that as evidenced kind of by the Russell 2000 at the bottom. It's down, it's up on the year about 1.65%. The equal weight index of the S&P 500 is about 5.5. So that's what is your average stock doing this year? It's up about 5.3%. Versus the broader market, which continues to be elevated through some of those magnificent 7 names. That's up by 9.7. The Dow is another really rate sensitive, very cyclical index there, up over 5% there. So there's a bit of breadth. The bond market still is struggling this year. We think that this will be the year that it reclaims glory, but it's down about 1% there. So bonds have struggled for the year as inflation still persists here. So the 60-40 is around 4.6. We're hanging in there. We're hitting all of our marks. We've got defensively positioned portfolios that we can ride through all of the waves of the storm here. and we continue to take our calculated bets as we see them. There are a few opportunities out there that we've been able to lean into. One of them this year was China. We got involved in China last year, and really I see China as uninvestable, but we kind of came to the conclusion that it's not untradeable. They're going through their own great financial crisis right now, so we allocated a small bit to them. They're actually one of the best performing stock markets in the G20 of this year, and so they're up about 24%. And so we take those calculated bets, but here domestically in the U.S., just not quite within our purview. So we'll kind of move along and start going through the hope cycle and start revisiting some of the updates there.
So on the
hope cycle.
Yeah, I'll go and do this part. Trey, the clients and friends, this small print that's almost impossible to see unless you blow it up shows 24 months. And basically what that means is when the Federal Reserve starts to increase rates, that it can take up to 24 months before a recession starts. Well, we're 26 months in since they started raising rates and we haven't had a recession yet. And a lot of people ask us, well, why has that not happened? And the answer for that is the level of fiscal spending by our government. Our government has been spending money equivalent to if we were in World War II, and it's not sustainable. And we'll show you some charts here later that backs that up, that without the government stimulus, we'd probably have been in a recession last year. So just quickly, housing goes into the tank first, which it did a couple of years ago. New orders follow, profits. The last part of the economy before we go into a recession is the employment part of the sector. And when employment goes in to a high layoff area, then the recession will start. So Trey, why don't you talk a little bit about the housing, the permits, and we're seeing a trend here where housing is really starting to slow down.
Right, so here's the home builder sentiment here. Below 50 is contracting, and above 50 is an expanding sentiment there in the home building market. Right now we see a 45, which is it's really just kind of skipped across the 50 line a couple of different times here. It's really just tracking rates. We flagged that a couple of months ago in one of the webinars, and as rates have come back up there, as measured by the 10-year, it's gone from 3.8 to 4.75, now hanging around the 4.4 level, 4.4%. So as rates go up, home builder sentiment drops there. So mortgage rates are hanging around 7%. That seems to be the psychological level that really starts to price people out of the market there. And so it was no surprise to us that home builder sentiment dipped back low. And every component of the home builder sentiment index here, they do break it down into a couple of other subcomponents. Every one of them declined this month. The gauge for prospective buyers out 6 months or more continues to hang around a 30. So that is really a recessionary reading there. So looking out the windshield of through the lens of the home builder continues to be really weak. And that generally does lead the index here. So we don't really see any optimism there from a sentiment perspective. Building permits is the next one we look at. We flagged a few months ago that we thought that this maybe start to roll over as rates were coming back up there. And we've started to see a lot of completions come online there. And housing starts, we're also starting to kind of reach thresholds there. So building permits now are just 1.44 million annualized here. So that's rolling back over and resuming its downtrend there. That's generally what you see as you're sliding into a recession there. High rates, high input costs are keeping both buyers and builders out of the market there. We've seen a lot of supply come online, especially in the multifamily space here in the latter parts of 23 and the early parts of 24. The good news is that's going to help us with inflation in the back half of this year and going into 25. All that supply is going to ease the rent pressure. The downside is that building activity is going to continue to slow, and that's going to put some downward cyclical pressure on the economy. So we slide right into the new orders portion of it here. So new orders, we're gauging the activities of purchasing managers across the U.S. This is a response index here, a diffusion index, and it's below 50. It's been kind of, again, going back and forth above and below 50. It is now contracting again, high rates. We saw a phenomenon early on in the year where purchasing managers were pulling forward their orders in anticipation of some anxiety around the election. That has subdued, and as interest rates have come back up there, as interest rate cuts have been pushed further out in the year, some of that optimism has come out of the market there. So manufacturing continues to be a weak point here and globally. Services here in the U.S., this has been the bright spot of the economy. It's still expanding at 52.2. Again, anything above 50 is good, but it is trending lower here. It reacts a little later than manufacturing, and so we expect this to go below 50 as we are entering in the recession. And at that point, it will be evident. Media will be talking about it. We're trending lower here. There's more color on this index that we're going to provide a little later on in the webinar, and some of the subcomponents there and what it's really, when we dissect it, what it's telling us. But services is waning here in a real way, and when that goes, so will the economy. One of the corporate profits is one of the other things we look at. That started to be impacted about 12 months ago, a little over that, and took a slight dip there. People were, the CFOs of all the companies were pulling on levers, cutting expenses, CapEx, R&D, all these other things to try to protect earnings. That has really exhausted itself. So earnings are kind of just moving sideways. They're still down from their high water mark. The expectation is earnings will contract here through the recession. That does bring down stock prices there. And ultimately, the things that they have tried to put a pause on in terms of expense line items, those have to resume in the future there as they reinvest in their business. Last thing we look at is employment. Initial claims for unemployment continue to remain pretty low here for the cycle. They have started to come up here through this year. We've really started to see a big pickup in the announcements of job cuts that will lead us to higher initial claims. Right now, the initial claims for unemployment remain pretty weak and paltry through the U.S. Post-COVID, there's not been any inflation adjustments to many of these, and in some cases 10 or 20 years. So most people are trying to supplement their income if they do find themselves unemployed through a means of gig economy. That is really a hot item right now. But continuing claims, if you are unfortunate enough to find yourself unemployed and you do file for unemployment, people are they are remaining on the unemployment registry for a very long time here, and we see that here in an unemployment rate. But continuing claims to be continues to rise here. That's generally what we would start to see as unemployment rate starts to spike and we slide into a recession. Unemployment rate's at 3.9%. Nobody had expected that this month. But that did pop back up to 3.9%. We're 0.5% off the low. That's kind of a back of the envelope way of figuring out whether you can expect a recession. That is triggered. We've got some other color on a number of other recession probability models that the Federal Reserve and other economists use later on. Unemployment rate 3.9%, slowly then all at once. That's what we're expecting to see here. We think the unemployment rate's going to rise to about 4.5% through this year and over 5% through next year. When the unemployment rate does rise, stocks do fall, but ultimately that helps clean the economy up of all of the excesses and gets us to a nice little light at the end of the tunnel. So this is generally where we start to see things get a little rocky, but that's kind of where we are in the hope cycle.
Yeah, thank you for Trey. And I drew that little blue arrow to indicate when employment spikes up, that normally kicks off when the recession will officially occur. Now, oftentimes when they do historical data on recessions, when they actually start, it actually occurs much earlier than people realize. And we'll talk about that in a slide here in a little bit. The next slide is inflation. And what you'll see here is this mountain chart, the gold or yellow is core services. And this is like your insurance, doctor services, professional services, and be a big part of the service economy we have. We're not seeing price cuts in those areas yet. And those aren't going to really occur until we have a recession and people get laid off and companies have to cut prices to retain market share. The purple area is core goods. That's come down. Gas prices, as you've noticed over the last couple months, has gone up a little bit of red here. Food is still elevated, but it's not as much as it was as before. But inflation is still with us, and it's stayed with us longer. This white line here, the 3.4, is a small drop. And Trey, you want to talk a little bit about the CPI number that came out this week?
Yeah, so CPI for the first time this year actually came in as expected. Prior reports, we had seen hotter than expected inflation. That's why yields were coming up. Stocks were kind of wobbling a bit here. So there is a restoration of a little bit of hope here that, we've seen kind of some of the peaks of inflation for the year. We think inflation is going to remain above 3% for this cycle until we have layoffs. It's going to take a recession to crush that embedded inflation, but we will get it out of the way. And the Fed, I think, will finish that job. They fumbled a little bit at the goal line here last December. They started talking about rate cuts. Everybody got excited about that. big bid in the market, and rates went down. And so they're having to kind of walk that back. But inflation is being persistent. We think it'll hang around that 3% level. It's going to be a lot of help in the back half of this year as employment really starts to loosen up. But it's still with us. We will get it gone. It's just going to take some more time, I think.
The next slide we want to talk about is the delinquency. The average U.S. consumer is really having a difficult time. And if you look at delinquency by the types of loans, auto loans is green, credit cards is blue, home equity lines is purple, and then mortgages is this gold line. The only loan that it seems people are paying, and paying in quotation marks, I'll let Trey talk about this in a minute, is student loans. But if you go back to the Great Recession in this time period here, you can see all these spiking up with the Great Recession. So you see a very similar trajectory with car loans and credit cards as we had prior to the Great Recession. In mortgages, back then, if you had a pulse, you didn't get one mortgage, you got three. So that's not as bad since it's much harder to get a mortgage. So we don't have that bubble forming. But the credit cards and loans are a problem. If you ever see a tow truck on the highway that has a car on its towing or on its flatbed, and there's no numbers or symbols on the tow truck, that's a repo company repoing a car. And we see more and more of those in the Dallas-Fort Worth area. The student loan area, it was kind of a conundrum, Trey. What do you think's going on there?
So student loans they're still reeling with a lot of post-COVID deferrals and stuff like this. The Biden administration has a number of different programs out there right now. Some of them more common that we see all the time. Some that have been stretched and broadened a little bit here. That are still we're seeing if you are becoming delinquent on your loan, there are income-based repayment plans. And if you are able to find yourself in that scenario, there actually are forgiveness plans that are still in the works right now. Actually, you have until the end of June to get involved in some of those. But there's still a lot of debt that's being waived off. Over 1 million different student loan borrowers thus far over the past 12 months have received some sort of forgiveness there. And so we're still in this, the wave is still kind of building of students that would otherwise have been delinquent on their loans. But the administration is being very forgiving for them. And if we think about it, I mean, student loans have a number of different forgiving programs, a lot of different flexibility, whereas you can lower your student loan down to, maybe $50 a month. But your credit card, if you're finding yourself where you spent money and, it's time to pay that back, and you've got to pay what, 25% interest, that monthly payment is not low. And there is no administration politically pushing you to extend that payment. There are very steep penalties for missing your credit card, and that interest does compound. And so people are actually prioritizing credit card payments above student loan payments right now, which is why you're seeing the differential in some of the delinquency rates. But this is really starting to affect fixed income seniors and young people. Everybody's getting squeezed by high interest rates and inflation that's still with us, and an income that really has not made any real improvements in almost 3 years now. And so these generally you'll start to see credit cards and auto loans spike. Mortgages actually are one of the last that you generally see. They start to track unemployment really well. So the fact that it's still normalizing, but the fact that we have any mortgage delinquencies is not a good sign in the economy. There's a lot of stress out there.
Yeah. And continuing on delinquencies, one of the big issues out of COVID was a lot of people worked at home. A lot of companies have recognized that not everyone can work at home. They're asking a lot of people to go back to the office. But what they realized is they didn't need all the office space that they had. So when you look at this chart, you're going back to January of 2002, here's the Great Recession here, and here we are today. What I want to focus on is the black line, which is office delinquency. That's the only one that's really spiking up significantly. And the question is this going to be a contagion that's going to spread to other parts of the economy, specifically the regional or small banks, because a lot of those regional and small banks lend money to the office buildings. And if they have enough tenants, they may just turn the keys back into the lender. Then it causes problems for that bank. So this is something we're keeping our eyes and ears on. In the DFW Metroplex, so many people are moving here from other parts of the country. It's not an issue, but it's a bigger issue, specifically in blue states, that people are moving from. So if we look at the next slide here, we're going to talk a little bit about another kind of divergence of the economy. And what you have is two charts here. The chart here on the top basically shows price increases with manufacturing and services. Services is the white and the orange is manufacturing. So prices are increasing. So as Trey has mentioned, we've been talking about inflation now for months. So prices are going up. Now the chart on the bottom, this is employment. And as prices are going up, employment is now falling for both services and now manufacturing had a little tick up here, but it's below 50, which is a contractionary movement. So people, they're not as secure in their jobs and they're having to pay a lot more for the goods and services they need to live. So that is not a good trend whatsoever. And this next slide continues the same theme. The stock market here is this kind of greenish line, continues to go up, a little dip here back in April. But if you look at the economic surprise index, so these are companies that are reporting information that, hey, our numbers are better than we anticipated. We really sandbagged and done well. But as you can see, this trend is steeply negative. So I would look at this as like a shark jaw that's opening. It's about ready to snap shut. So it's not posing well for future good times economically. So the next two charts, I'm going to turn this over to Trey because a lot of people are saying, well, Mitch and Trey, you've been talking about this recession. It's not here. Is there any other information other than you guys that back up what you're saying? And the next two pages, we have some very solid information that backs up what we've been talking about. So Trey, I'll go ahead and let you talk about these next two slides.
Yes, we're going to go through two slides, two charts on each slide here. What we're looking at is different recession probability models that the Federal Reserve utilizes and a number of other prominent economists here. So we have 4 total models. 3 of them have triggered signals for recession. These are meant to not only dictate whether a recession will happen, but when it will happen. So the first one we're looking at here is the McKelvey rule. It's the top left here. Without trying to bore anybody with the economic details, it's trying to measure the unemployment rate, the moving average of the unemployment rate versus a local low. When it rises above a certain threshold there, every time since the late 1960s, we've seen a recession. We triggered that signal in October of 23. There were a number of things that happened around that time period. We've gotten fourth quarter jobs for that period that would look like what, pretty healthy jobs for that fourth quarter actually have been revised to contractionary jobs. The Beige Book from the Federal Reserve, which is it's an anecdotal survey from businesses all over the country, really showed a deceleration. And there's a saying that I think I heard Jeff Bezos say a number of years ago, which says, if the data says it's good, but your customer says it's bad, you better listen to your customers. And so there are a lot of anecdotal, and I think we all know them at this point, of somebody who's looking for a job, somebody who's struggling because of high interest rates or delinquencies, bankruptcies, etc. So October 23, this model shows that when we look back in time a year or two from now, when they go to try and date this recession, October 23 is one of the points here that this model shows. This is one that the Federal Reserve does use to try and assess economic strength here, or in this case, weakness. The one on the right here, this is the Piper-Sandler rule. They're a research firm and an investment bank there. So what they're trying to do is look at the unemployed persons in the economy, and they're looking at it through a rate of change basis, so a year-over-year figure. And so when those unemployed people, the volume of them increases above 10% year over year, you've seen a recession every time since 1950. And we're currently at 10.5%. So that rule has triggered. So we've got 2 models that have showed that a recession with 100% accuracy, a recession should be expected, and in some cases it's already started. The last 2 models that we look at here, the top left is one that the New York Federal Reserve used. It's a measure of credit spreads, yield spreads in the economy there. And so we're currently, over the next 12 months, you should expect a 50% odds of a recession here. And so a coin flip. Okay. The problem is that we've had several different recessions since 1960 that didn't even peak out at 50%. And every recession, every reading of 50% or more was in a recessionary territory. So this is one that has 100% accuracy, is reflecting a recessionary reading that will occur. A recession will have started in the next 12 months there. Again, that goes back to 1960. So we've triggered that rule. That's 3 total models and 3 confirmation signals. The last one we have is a SOM rule. This is one of the most prominent ones, most of the popular ones. This is one that has not triggered quite yet. Very similarly to the McKelvey rule, this is looking at the moving average of unemployment versus a local low. And so this one needs to get above 0.5 coefficient. We're at about 0.37. All we need to do is either increase unemployment by 0.1% from these levels, or hold 3.9% consistently for at least the next 3 months. And this rule will trigger. So it's almost all but a guarantee. So this will be the fourth rule that will have been triggered. And all four of these rules have a 100% prediction of a recession within 12 months' time, going back to, in some cases, 1950. So we're only one model that hasn't triggered, and it almost has to at this point without an immediate reversal in unemployment. So there's a lot of validation that things are, that a recession is coming. That's generally not good for risk assets. And so we think that we know that markets are starting to price this in. We're starting to see that in the hard data. We're going to talk about that in the GDP and the jobs print here in just a second. But these are four models that we want clients to get familiar with. These will show us when we're getting out of a recession, which would be a good signal. That's when we can turn the risk switch on and buy some stocks, get paid for them, have a nice safety net underneath us. Right now, it's time to start hunkering down.
Yep. Thank you, Trey. And these two slides, we are going to be using these in our meetings here for the next few months. So those of you that come in for meetings or have go to meetings, we'll share these with you and we can have a conversation around them. But this is some really good work that Trey and Nick have put together. It kind of answers the question, where's the recession? You're not going to see this on the news at night or in social media because it doesn't fit the narrative. Everything's hunky-dory if you listen to those outlets. So let's talk a little bit about earnings per share. Basically, what we're looking at in this particular slide, companies are beating their earnings per share despite weak revenue beats. And what that basically means is when you're trying to hit an earnings per share, you can control your expenses. You really can't control your revenue that much. So you see people cutting corners where they can to make their number, to keep their job. You can't do this forever. Think of a sprinter being asked to run a marathon. They can't last that long. So this is a trend that cannot continue, but it's also another negative data point that indicates that the recession is imminent. If we talk about GDP going back, and you're going back to the first quarter of 2021, here's the false recession in the first part of 2022. If you look at the real GDP and you have this spike here in 23, there's some really interesting data points, Trey, I'd like for you to share with our webinar attendees that a lot of people are not aware of.
Yeah, so this chart here is just showing real GDP quarter over quarter annualized. So we got a reading of GDP a few weeks ago that showed for the first quarter of this year, growth missed. Actually, it was I believe a 5 standard deviation miss away from the median economic estimate. And so we got 1.6% annualized growth in the economy in the first quarter of this year. And economists were looking at about 2.5% there. And what we saw was, all of last year was propped up by the fiscal impulse there from the administration, and we know that that's a flash in the pan. That's not sustainable growth, and so we knew it was going away, and so we really wanted to assess that in Q1, and we got that validation. Growth inputs and growth attribution in the economy coming from government spending were incredibly low, and so that when we remove the government spending from the economy, all of a sudden we figure out that the real economy is actually on fumes here. And so this was one of the weakest quarters that we'd seen since that false recession at the beginning of 22. And so we want to contrast that the last year, the fiscal year in 23 was a year that should have had a recession, but the fiscal impulse was so strong, we spent like we were in wartime from the federal government, that it really kind of forestalled the recession last year. 24 will be a year that all that gets rectified. There's no fiscal impulse in the pipeline that will change that by this point. We knew that the fiscal impulse would get out of the way and that you'd be left with a real economy, which is on fumes. Last year, from the fourth quarter of 22 to the fourth quarter of 23, the economy grew nominally about 6%, and the government was responsible for about 4 of that 6%. And that had strong reverberations out the economy, but that was a flash in the pan that's behind us. We see that even evidenced by the next chart, which is the payroll survey that we had last month. So not only did the economy miss on expectations of growth last year, so did jobs. So right here, I apologize, we can't change the color of this chart. It's a Bloomberg chart. I would if I could. But what we're looking at is what are how many thousands of jobs are the government responsible for in the payroll surveys that come out every single month. And what you'll see here is 21 and 22 is very sporadic, no real trend there. In 23, you see a strong input there from government job attribution. What we saw in the first jobs report here, the most previous jobs report here in April, was a big miss on jobs. We were looking for over 250,000 jobs created in the economy. We only created 175. Now, at absolute level, that's still an okay level, but it is below neutral, so things are starting to weak. And lo and behold, we saw that government input to those jobs had actually fallen off a cliff there. So we're kind of asking ourselves, is the government hiring spree really finished here? Because if it is, then you're going to start to see a big slowdown in jobs in a real way, and a big slowdown in the economy in a real way. This was some of the validation we wanted to look for in Q1. We think that has really just validated that thesis here, and we think that this is, if it persists, 24 is going to be the year that we go into recession.
Yeah, that's a real important point. In the webinar we had last month, we basically showed a slide where government hiring had actually been a long-term decrease, but this current administration, there's been a big increase of people being hired by the government. But this administration prefers big government, a lot of rules and regulations, and you can have a lot of people to carry out all the rules and regulations that are being passed, which is a lot of red tape and problems for business. This next chart, we're going to talk about why bonds are such a good part. We've added a lot of bonds to our portfolios. Again, there's an opposite relationship of bond prices and yields. This bottom chart here basically shows that. So when you have low rates, you have high bond prices, bonds are at high risk. So that's where we were back in the COVID year of 2020. And if you have rising inflation. So in 2022, it was the worst year ever for bonds because they came off the floor and the Fed was raising rates. And then as we migrate to the Northwest here, 2023, bonds are low risk because rates are much higher, and we're going to have a situation where we're going to have falling inflation. We've kind of hit a peak of inflation last year, and inflation is coming down, but it's still with us. This chart here on the upper left part of it shows the impact of the maturity of bonds and how much would the rates need to increase before you would start to lose money in various bonds based on their maturity or duration. So a 2-year bond back in 2020, if it rose 20 basis points, which is 0.2%, you would start losing money. Now, because rates are so much higher, it'd have to go up 5.2%, 520 basis points. So that is significant. And the longer duration bonds, as we come down here, you can kind of see a similar type pattern when it's just rates are most likely going to go down. Even if they went up a little bit, you're getting so much coupon payment for the longer duration bonds that makes up for that bond price that may be impacted negatively. So we're holding a lot of bonds in the portfolio. We've told everyone on the call, please be patient. These bonds will be profitable. They will help you. Generally, when the stock market goes down, people will pull money out, invest in cash or bonds. We think that will happen. The other thing you'll see happen is that the Fed will cut rates much more aggressively if we're in a recession. And we are in an election year. I think Jerome Powell wants to keep his job. So I don't think he would be too stubborn and not cut rates aggressively if we start going into a recession. And as we've talked about already, we think we're right at the recession's door. One thing that we're seeing internationally is that you're seeing rate cuts from around the world starting to occur. The other countries from around the world haven't been like drunk sailors on shore leave with fiscal spending. They've been a lot more disciplined than we have in our country. And so they're a little bit further ahead in the economic cycle, and they're having tougher times right now. But you're starting to see the talk and rate cuts are going on in other parts of the world. And if we look at our country, this is a chart we've shared in prior webinars. This is when the Fed meets in these rows in the column headings, the Fed funds rates between 5.25 and 5.5%. Now the first anticipated rate cut is going to be September, and they'll have another one in December. Now, this chart changes daily and based on economic data. So we may see more rate cuts than 2 at the beginning of the year. And Trey had talked about this. They were anticipating 6 rate cuts, but that inflation data remained too sticky. And I think Jerome Powell and the Fed got ahead of themselves. And as Trey articulated, they kind of fumbled the ball at the goal line. So we are going to work through this. And unfortunately, we're going to have a recession to get rates down to where they need to be. As we kind of wrap up our webinar, we kind of finished with our option-heavy portfolios that generate income. And these are the numbers that we tell people will generate on $1 million amount of income. This is actually the trailing 12 months of what we've done. What's been really interesting, Trey, is Advantage is now outpacing stock income in terms of income generation. I'm guessing this is because of the NASDAQ and the S&P 500 indexes have had more growth. So we've had a lot more latitude to generate more call income.
Right, exactly. And ADV is almost fully allocated, whereas stock income, it's only got half of the volatility of the market. It's got tons of safe cash there. So we're actually able to hit our yield targets while holding on to a bunch of cash and remaining safe. We've done everything we can in ADV because of that NASDAQ exposure. We let it breathe. We get that yield. We want to try and be as safe as we can.
Wonderful, wonderful. All right, that completes our webinar for May of 2024. We talked about the impact of the continued inflation. We talked about the declining economic numbers through the hope slide. We also discussed some new recession targets and markets that we'll be including, showing that we're right on recession's door. So I'm going to go ahead and stop the recording now and open